The second half of our lecture for this week is going to focus on revenue recognition. Now, many revenue transactions, which are the backbone of how companies make money, are initiated and completed at the same time. If you think about, you walk into Target, you buy a pack of toilet paper, you check out, you pay with cash or a credit card or a debit card. The company records revenue, and therefore there are little problems in terms of revenue recognition. It's a pretty straightforward transaction. However, when there are multiple products, so a bundle of products or products and services together, or when there are long-term product or service arrangements, discounts, upgrade options, revenue recognition becomes a little bit more challenging. Additionally, revenue recognition is one of the hottest topics for the FASB, the Financial Accounting Standards Board, company executives, regulators, the SEC, and some of the reasons for that are that revenue is a key component to several really important financial measures, like EBITDA, which is earnings before interest, taxes, depreciation, and amortization, net income, and EPS. It's also the most prevalent reason for accounting restatements. And it's an important measure for financial performance for investors and analysts. If you look at a company's quarterly or annual earnings, they're almost always going to be talking about their growth in top-line revenue. Or if they didn't have growth, their decline in top-line revenue. And so for all of these reasons, the FASB really wanted to take a look at the guidance for revenue recognition and try to enhance it. So effective 1/1/2018, so just over a year and a half ago, new guidance came out. That guidance is called Revenue from Contracts with Customers. It's also referred to as Accounting Standard Codification 606. And it had a number of objectives. First and foremost, it wanted to converge US GAAP and IFRS. As you may be aware, there's been a project for about the last 15 years to converge US GAAP and IFRS so that we really kind of had one single standard of accounting rules. By issuing ASC 606, it provides a more robust framework for addressing revenue recognition issues. And one of the biggest advantages was that it's supposed to improve comparability of revenue recognition practices across industries and companies. So previously, within US GAAP, there were a number of different standards that focused on revenue recognition, and there were standards that specifically covered certain types of revenue transactions for specific industries. And so one of the things that ASC 606 did was really centralize all of the revenue recognition policies in one place, and by doing so simplified the preparation of the financial statements because companies don't need to go to all these different standards in order to figure out what rules they need to follow. And then finally, it also is requiring some enhanced disclosures to help financial statement users understand the amount, timing, and uncertainty of recognizing revenue. So, the new standard takes something that we call an asset liability approach. And under the asset liability approach, it measures revenue based on changes in asset and liability balances. And the thinking is that by focusing on the recognition and measurement of assets and liabilities and the changes in those accounts over the life of the contract is more reliable way to measure the revenue compared to the previous method, which was largely based upon the earned and realized criteria. So I just want to take a minute because many of you may have learned the previous revenue recognition policy. So I just want to take a minute to go over what that used to be, but please keep in mind that that is no longer the policy, which is why in my slides I have X'd it out. So prior to 1/1/2018, the guidance said that the revenue recognition principle was based on recognizing revenue when the revenue is realized or realizable and when it has been earned. And so then the key component to that was determining what realized, realizable, and earned meant. So realized was that a company had exchanged goods and services for cash or claims to cash. Realizable was that assets a company receive in exchange are readily convertible to known amounts of cash. And then earned was that a company had substantially accomplished what it must do to be entitled to the benefits represented by the revenues, aka the earnings process is complete. But what you can tell from this is that there was a lot of gray area around what substantially accomplished meant. And so as a result, and with clarification through the new accounting guidance, ASC 606, there is now a 5-step process for recognizing revenue. So the 5 steps are to identify the contract with the customers, and this is the first step of the process because it is really a contract that initiates a revenue transaction. Because the contract provides the terms of the transaction, the measurement of consideration, and the specific promises by each party, which you'll come to find out in a minute are called the performance obligations. Now, it's also important to remember that when it says a contract, that a contract doesn't necessarily have to be a formal, written, 500-page document, right? Contracts can come in many shapes and forms. It could be written. It could be verbal. It could be scribbled out on a Post-it note. It could be typed up and lawyers go through it. So when you think of the word contract, I want you to think very broadly about what that can mean. So step 1, identify the contract with the customers. Step 2, identify the separate performance obligations in the contract. Those are the promises that each party is going to complete. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the separate performance obligations. So this is key when there are multiple products or services being offered, or when there's products and services being offered. And then step 5 is to recognize revenue in the accounting period when each performance obligation is satisfied. And so step 5 is really the new revenue recognition principle. So out with when it's realized or realizable and earned, and in with recognized revenue in the accounting period when each performance obligation is satisfied. So now we're going to take a little bit closer look at each of the steps. So step 1 is to identify a contract with a customer. So companies are going to look at each contract individually, and they are going to be able to determine that a contract exists if the contract has commercial substance, meaning that something of value is being exchanged. The parties have approved the contract, and again, it doesn't mean it has to be signed. It could be written or verbal. The identification of the rights to the parties is established. Payment terms are identified, and it is probable that the consideration will be collected. Now, for this step 5 component of step 1, what they're really looking at is making sure that the parties to the contract are committed to perform. So what I mean by that is this is not a collection issue. This is not about whether or not the company is going to pay whatever amount it's owed. What this is really getting at, because that's an allowance for doubtful accounts question, what this is really getting at is, did the parties enter into the transaction in good faith, right? If I am, if I work at a grocery store and I make $20 an hour, right, and I go to the dealership and I want to buy a $250,000 vehicle, right, I'm probably not entering that transaction into good faith because I don't actually have a way to pay for that vehicle if I don't have, savings already saved up for it, because my salary is not going to be able to help me pay that monthly car payment. So that's what component 5 of step 1 is really getting at. So when we take a look at an example, on March 1st, 2017, Twix Company enters into a contract to transfer a product to Mars on July 31st of 2017. The contract is structured such that Mars is required to pay the full contract price of $5,000 on August 31st of 2017. Twix does not foresee any collection issues. The cost of goods transferred is $3,000, and Twix delivers the products to Mars on July 31st. So, what we have here are a couple of performance obligations. So, the first performance obligation is that Twix needs to transfer a product to Mars on July 31st. There's another performance obligation that Mars needs to pay for those goods or that product on August 31st of $5,000. There's no foreseeable collection issues, and they also tell us that the cost of goods sold is $3,000. Okay, so we know that the transaction price is $5,000. We know that the contract has commercial substance because product is being transferred for cash. The parties have approved the contract. They've entered into the contract. We know who the parties are. It's Twix and it's Mars. The payment terms are identified. Payment is due 1 month after delivery. And as we already mentioned, we don't foresee any collection issues. So, once a performance obligation is performed, and that performance obligation would be that when Twix transfers the product to Mars, we can go ahead and record revenue. So we are going to debit accounts receivable for $5,000 and credit sales revenue for $5,000. At the same time then, we need to debit cost of goods sold for $3,000 and credit inventory for $3,000. So this example, if you recall back from your intermediate accounting 1 class, is following the perpetual method where cost of goods sold entries are being recorded as soon as a sale occurs. And then on August 31st, we receive the cash, so we are going to debit cash and credit accounts receivable. So, pretty straightforward example. Step 2 are the performance obligations. So a performance obligation is a promise to perform a distinct product or service to a customer. That product or service is distinct when a customer is able to benefit from that good or service on its own, or benefit from that good or service together with other readily available resources. So what that basically means is you go and you buy a car, right? Unfortunately, that car isn't just going to work on its own. It needs to be filled with gas. However, gas is a readily available resource, so the product is going to be able to be used by the customer as long as the customer can get some readily available gas. The objective really is to determine whether the nature of the company's promise is to transfer individual goods or services to the customer, or to transfer combined items for which those individual goods or services are inputs. I already mentioned before that the promise can be explicit, it can be implicit, or it can be based on customary business practices. And it is also possible that within a contract there can be multiple promises or multiple performance obligations. Step 3 is the transaction price. This is the amount of consideration that the company expects to receive from a customer. Now, in a contract, this is usually very easily determined because a customer agrees to pay a fixed amount. However, in some instances, a contract may have variable consideration, there may be time value of money considerations, non-cash consideration, or there could be a component of a contract where consideration is going to be paid or payable to the customer. So we're going to look at each of those next. So variable consideration is a situation in where the price that is going to be paid by the customer depends on future events. And that could be because of discounts or rebates or credits, could be because of performance bonuses or royalties. So companies need to estimate the amount of revenue to recognize using one of two methods, either the expected value method or the most likely amount method. So under the expected value method, that is based on a probability weighted amount within a range of possible consideration amounts. So if you have 5 different possible outcomes, and each outcome is weighted with a 20% probability, you're going to take each of the 5 outcomes times 20% and add them all together, and that is the amount of revenue that you would recognize. The expected value method is typically appropriate when a company has a large number of contracts with similar characteristics. And it is used when there are a limited number of discrete outcomes and probabilities. On the other hand, the most likely amount is the most likely amount in a range of possible consideration outcomes. And this one is usually most appropriate when the contract only has 2 possible outcomes. So below is an example where we're going to look at variable consideration. So, Almond Joy enters into a contract with a customer to build a warehouse for $100,000. And then attached to that is a performance bonus of up to $50,000 that would be paid based on the timing of completion. The amount of the performance bonus is going to decrease by 10% per week for every week beyond the agreed upon completion date. The contract requirements are similar to contracts that Almond Joy has performed previously, and therefore, based on historical experience, management believes that there is a 60% probability that the contract will be completed by the agreed upon completion date, a 30% probability that it will be 1 week late, and only a 10% probability that it will be completed 2 weeks late. So how should Almond Joy account for this revenue arrangement? So assuming that they believe that the probability weighted average method is the most predictive approach, they are going to take the entire $150,000, so the $100,000 that's the fixed component, the $50,000 that's variable, and multiply that by the 60% chance that it will occur. Then there is a 30% chance that it will be 1 week late, and therefore they will lose $5,000. So a 30% chance of $145,000. And then there is a 10% chance that it will be 2 weeks late, and that they'll lose 20% or $10,000. And so that is 10% of 140. So you take those probabilities, multiply it by the possible amounts, and then add them all together, and you get $147,500. So that would be how much Almond Joy would record with under variable consideration. Now, if we just take a minute and go back, what happens if they were to decide that they should use the most likely amount instead? If they were going to use the most likely amount, then they would record $150,000. Okay, so for variable consideration then, once we've determined which method we're going to use, we're only going to allocate variable consideration if it is reasonably assured that the company will be entitled to the amount. Companies should only recognize variable consideration if they have experience with similar contracts and are able to estimate the cumulative amount of revenue based on experience, and they do not expect to see a significant reversal of revenue previously recognized. If this criteria is not met, then we say that revenue is constrained. So, constrained revenue recognition means that the amount of consideration, and when I use the word consideration, most often I'm talking about cash, is highly susceptible to factors outside the company's control. This often can happen with volatility of markets, judgment of third parties, weather conditions, high risk of obsolescence, and there can also be uncertainty about the amount of consideration for a long period of time. Constrained revenue recognition can also occur when a company's experience with similar types of performance obligations that are similar in nature is limited. So this could be when there's a new product on the market or a new type of service. This can be the company's just starting up and doesn't have a lot of historical experience. Those are just some of the examples or the reasons why a company might have limited performance obligation experience. And it's also possible to have constrained revenue when there's a large number and a broad range of possible consideration amounts. So I mentioned earlier that sometimes time value of money needs to be taken into consideration when it comes to the transaction price. So oftentimes a company may receive consideration after the product is provided or the services are performed. So in the example that we went through earlier, the company received the goods on July 31st, but didn't have to pay for them until August 31st. And so therefore, essentially what's happening is the seller is providing financing to the customer. Now, most of the time lag between when the products or the services are provided and when payment is made is going to be relatively short, right? Most companies that sell goods on account have a 30 to 60 day payment terms. So when a contract or a sales transaction involves a significant financing component, interest is going to accrue on the consideration to be paid over time. The fair value is going to be determined either by measuring the consideration received or by discounting the payment using an imputed interest rate. And the company is going to report interest expense or interest revenue. Now, in theory, right, the seller should be recording interest revenue because they are likely going to charge more for the good or service than because they're going to receive the cash in the future than if they were to receive the cash today. But it's also possible that a company might actually, to entice someone to buy something, might provide the financing basically free of cost and therefore having to report interest expense. So, if we look at an example, on July 1st of 2018, Jolly Rancher Company sold goods to Good and Plenty Company for $900,000, in exchange for a 4-year zero interest-bearing note with a face amount of $1,416,163. The goods have an inventory cost on Jolly Rancher's books of $590,000. Jolly Rancher uses the straight-line method of amortization. So the question then is, how much revenue should Jolly Rancher record on July 1st and on December 31st? So the entry to record Jolly Rancher's sale to Good and Plenty on July 1st is going to be a debit to notes receivable for $1,416,163, a credit to sales revenue of $900,000, and a credit to discount on notes receivable for $516,163. At that same time, then, we're going to record an entry for cost of goods sold and inventory for $590. And then, at the end of the year, December 31st, because they're using the straight line method and not the effective interest method, they are going to take the $900,000. They are going to multiply it by 12%, which is the interest rate, and then this is semi-annual, so we're going to multiply it by 1/2 and get $54,000. So we are going to debit discount on notes receivable for $54,000 and credit interest revenue for $54,000. So essentially what's going to be happening here is Jolly Rancher is going to have sales revenue of $900,000. They are also, over the course of this 4-year note, going to record $516,163 worth of interest. Now, keep in mind that companies are not required to reflect time value of money if the time period for payment is less than a year. They basically say, you know what, it's not worth it, it's not material enough to consider time value of money as long as payment is going to be made within a year. And then finally, when it comes to transaction price, we need to look at non-cash consideration and consideration paid or payable to customers. So first, for non-cash consideration, a company might receive a contribution, which could be a donation or a gift. The customer might contribute goods or services, such as equipment or labor, as a component of the transaction or of the contract. And so when it comes to non-cash consideration, companies need to recognize revenue on the basis of fair value of what was received. So for example, let's say that I buy a piece of machinery and I have to pay $500,000. But in addition to paying that $500,000, the company that's selling me the equipment would normally ship it, pay for shipping, and deliver it to my location. However, instead, I have told them that I will provide the shipping myself, so I am providing a service, and that is the shipping. And so what needs to then happen in terms of the company that's selling me the goods is they need to take the price, the $500,000, plus the fair market value of what the services that I'm providing, and add those two together to determine how much revenue is being recognized. And then finally, we have consideration paid or payable to a customer. And so when you think about this, what this really comes down to is discounts and volume rebates and coupons and free products or services. And typically what this happens is it's not actually the seller cutting a check necessarily to the buyer, but instead what it does is it reduces the amount of consideration that the seller is going to receive from the buyer. And therefore, because it reduces the amount of consideration, it also is going to reduce the amount of revenue that can be recognized. So this is an example here where Kit Kat Company offers its customers a 3% volume discount if they purchase at least $2 million worth of products during the calendar year. On March 31st of 2017, Kit Kat has made sales of $700,000 to Candy for Us, and in the 2 previous years, Kit Kat sold over $3 million to Candy for Us in the period from April 1st to December 31st. So we have historical evidence that says that at least that $2 million threshold is going to be made. So the amount of revenue that Kit Kat should recognize then is only 97% of the $700,000 sale amount, which is $679,000. And the reason again for that is that it's probable that it's going to provide this rebate based on historical experience. Step 4 is to allocate the transaction price to separate performance obligations. This is going to be based on their relative fair values, aka their standalone selling prices. If relative standalone prices are not available, then companies should use their best estimate of what the good or service might sell for on a standalone unit. I was going to provide an example here, but then I realized this is exactly the same as allocating lump sum purchases. So when you have lump sum securities or you have lump sum fixed assets, you allocate the amount based upon their relative fair values. So you're going to follow the same approach here. And then finally we get to step 5. Step 5 is that we are going to recognize revenue when or as each performance obligation is satisfied. So a company satisfies its performance obligation when the customer obtains control of the good or service. Now, this step requires judgment, and the assessment of whether or not the customer has obtained control should really be focused on looking at it from the customer's perspective. Now, control is generally defined as the ability to direct the use of and obtain substantially all of the benefits from the product, or the ability to prevent other companies or other individuals from directing the use of or receiving the benefits from the asset. Now, change of control indicators are listed next. What I want to highlight here is that these are not requirements. These are just things that tend to dictate or tend to insinuate that the change of control has happened. So the company has the right to payment for the asset. The company has transferred legal title. The company has transferred physical possession. The customer has significant risk and rewards of ownership. So think of that from an insurance perspective. If it were to burn down, who has the risk of it burning down and having to go and trying to recoup insurance proceeds? Or if it's an ice cream machine, right? Who has the rewards of benefiting from the sale of the ice cream? And the 5th one is the customer has accepted the asset. Okay, now, one of the complications that can arise is when revenue recognition from a performance obligation occurs over time. So I mentioned at the beginning of the lecture that most revenue recognition transactions are very straightforward. You go into a store, you buy something, you pay for it, you walk out, revenue recognition is done. Where this comes into more challenging territory is that when a performance obligation occurs over time and you need to measure progress towards completion. So the method of measuring progress towards completion should depict transfer of control from company to customer. The most objective methods of measuring the extent of progress is usually in terms of cost or units or value added. And we do a cost to cost or a unit of delivery method. Now, the most popular cost to cost method is the percentage of completion method, where a company is going to measure the percent of completion by comparing the cost that it has incurred to date with the most recent estimate of the total costs for the project to be completed. And the accounting for that, or the process for that, is in Appendix A at the end of these slides. And I will be recording a separate quick video on that. And then finally, I just want to point out that service arrangements are often done on a straight line basis. And the reason for this is because the performance obligation is typically satisfied ratably over the contract period. So if you think about like a cell phone service contract, right? You know, the cell phone company is providing you the same service month after month. So to the extent that you had to pay for some cost up front, they are going to be recognizing revenue on a straight line basis over that contract period. This next slide is just a summary of the 5 steps. So, you know, we went through all of the steps in detail on the previous slides. This kind of brings it all back together and summarizes it in one chart. Okay, now, even though we've gone over kind of the overall revenue recognition process and the step process, there are a number of other revenue recognition accounting issues that need to be taken into consideration. So on this slide, we have several of the accounting issues that primarily relate to issues around transaction price determination, which is step 3 of the revenue recognition process, and when control of goods and services has passed, which is step 5. So we're going to next take a look at sales return and allowances, bill and hold arrangements, principal-agent relationships, consignments or consigned goods, and non-refundable upfront fees. So in sales returns and allowances, usually the right to return a product or service is allowed for a period of time because of dissatisfaction with the product, wrong size, wrong color, etc. The company or person returning the product can receive, a full or a partial refund, a credit that can reduce other amounts that they owe, or even another product in exchange. So if we look at an example, on January 12th of 2017, Amsterdam Company sells 100 cameras for $100 each on account to London Inc. Amsterdam allows London to return any unused cameras within 45 days of purchase. The cost of each product is $60, and Amsterdam estimates that 3 products will be returned. The cost of recovering the products will be immaterial, and the returned products are expected to be resold at a profit. So on January 24th, London returns 2 of the cameras because they were the wrong color. On January 31st, Amsterdam prepares financial statements and determines that it is likely that only 1 more camera will be returned. Amsterdam is going to make the following journal entries. So we are going to, originally for the sale of the cameras, we are going to debit accounts receivable for $10,000, credit sales revenue for $10,000. At the same time, we're going to record our cost of goods sold entry and reduce our inventory for $6,000. When the 2 cameras get returned, we are going to debit accounts receivable. Oh, that is not correct. They're the wrong amounts. We are going to credit accounts receivable for $200. We are going to debit sales returns and allowances for $200. We are going to credit cost of goods sold for $120 and debit inventory for $200. And then We also need to account for the estimate of the remaining expected return. And so that is going to be a debit to sales returns and allowances for 100, a credit to the allowance for sales returns and allowances for 100, debit to estimated inventory returns of 60, and credit cost of goods sold for 60. In a bill and wholesale arrangement, the buyer is not yet ready to take delivery or physical possession, but it does take title and accept billing. And the reason for this might be that the buyer doesn't have available space for the product yet, or they may not need the product for what they're ultimately going to use it for, or that they may already have enough sufficient inventory in its distribution channel, but it's possible that they want to take advantage of a volume discount or make sure that they have enough product on hand for later in the year when they know they're going to have a large amount of sales. So because title and billing have been accepted, we are going to go ahead and record the sales transaction by debiting accounts receivable and crediting sales revenue, as well as the entry for cost of goods sold and inventory. Principal-agent relationships. So this is a relationship in when amounts or cash is going to be collected on behalf of the principal, but they are not revenues of the agent. So instead, revenue for the agent is the amount of the commission that it usually receives. So this is a percentage of total revenue. So a really good example of this are online travel agents or OTAs like Priceline and Expedia. Right? Priceline and Expedia act as an intermediary. They are an agent for airlines, car rental companies, and hotels. Those hotel companies, airline companies, and rental car companies are the principal. So the online travel agent is entering in transactions on behalf of the principal. So you go to Expedia and you book a $100 a night hotel room, and you're going to go stay at a Comfort Inn. Okay, so you're going to pay $100. Now the OTA might get 15%. So the OTA is going to get to record commission revenue of $15. The hotel company is going to record hotel revenue of $100, and they are going to record commission expense of $15. Another accounting issue that we have with revenue recognition is around consignments. So consignment stores are a specific type of principal and agent relationship. A manufacturer or a wholesaler delivers goods to a location or to a store, but retains title to the goods until they are sold. Now, the consignor, which is the manufacturer or the wholesaler, ships the merchandise to the consignee, which is going to be the dealer, who is to act as an agent for the consignor in selling the merchandise. The consignee is going to accept the merchandise and agrees to exercise due diligence in caring for and selling the merchandise. The inventory remains on the books of the consignor, the warehouse, or the wholesaler, or the manufacturer. And the consignee is going to make a commission, which is going to be commission revenue on the sale. The consignor is going to record the sales revenue for the product, the applicable cost of goods sold, and the commission fee expense. And then finally, we have non-refundable upfront fees. So non-refundable upfront fees are typically payments that are going to be made by a customer before delivery of a product or performance of a service. Generally, these relate to initiation, activation, or setup fees for goods or services, and in most cases, upfront payments are non-refundable. You see this with membership fees for a health club or activation fees for phone, internet, or cable. So most often these payments are related to the future delivery of products and services, and therefore they cannot be recorded as revenue at the time of payment. Most likely they will be recorded as revenue over the course of the contract on a straight line basis. And then finally we come to revenue recognition, presentation, and disclosure. So I mentioned at the very beginning of the class that the new revenue recognition policy is based primarily on contract asset and liabilities. So a contract asset arises from one of two situations. The first situation is a contract asset can arise when there is an unconditional right to receive consideration because the company has satisfied its performance obligation with a customer. The best example of this would be recording accounts receivable on the balance sheet. Okay? I've provided the good or service, my performance obligation is complete, now I am entitled to payment. The second type of contract asset is a conditional right to receive consideration because the company has satisfied one performance obligation but must satisfy another performance obligation before it can bill the customer. And in this situation, what we end up with is a contract asset on the balance sheet. Now, you're not actually going to see on the balance sheet an account called contract asset. But what is important is that on the balance sheet, companies must differentiate between unconditional rights and conditional rights. So they can't be lumped into the same account, aka you can't use accounts receivable for both. Additionally, it is also possible for a company to have contract liabilities. And this is when a company's obligation to transfer goods or services to a customer hasn't happened yet, but the company has received consideration from the customer. And the best example I can give of this is when a company records unearned sales or service revenue. Typically indicates that they've received payment, but they haven't provided the good or the service yet. So on this next slide is an example, and in this example there are two products that need to be transferred, product A and product B. However, the contract specifies that payment for product A will not occur until product B is also delivered. So New York company has determined that the standalone prices are $30,000 for product A and $70,000 for product B. New York company delivers product A to Yankee on February 1st, and on March 1st they deliver product B. So what entries should New York company make with regards to this contract? So on February 1st, which is when they deliver product A, okay, they still have not completed the performance obligation, and that is because the performance obligation says you will not be paid until you provide both products. So on February 1st, we are going to record a debit to contract asset for $30,000 and a credit to sales revenue for $30,000. The reason that this is not a debit to accounts receivable is that we do not have an unconditional right to this money yet. We still have an obligation to provide product B. Then on March 1st, when the other product is delivered, we're going to record additional sales revenue of $70,000. We're going to credit the contract asset for $30,000, and now we have an unconditional right to the money, and therefore we are going to record accounts receivable of $100,000. Here is another example. On March 1st, 2019, Hank Company enters into a contract to transfer a product to Jackson Inc. on July 31st. It is agreed that Jackson will pay the full price of $10,000 in advance on April 15th. Hank delivers the product on July 31st. The cost of the product is $7,500. So on March 1st, no entry is required because neither party has performed their performance obligation. On April 15th, then, we are going to receive the cash. So we're going to debit cash for $10,000, credit unearned sales revenue for $10,000. Then, once the performance obligation is satisfied on July 31st, we are going to debit unearned sales revenue for $10,000, credit sales revenue for $10,000. We also will record our journal entry for cost of goods sold. We will debit cost of goods sold for $7,500, credit inventory for $7,500. Okay, and then finally, what do we do when we have contract modifications? So, a contract modification occurs when there is a change in the contract terms while the contract is still underway. What is important for us to do in these situations is to determine whether we have a new contract and therefore new performance obligations, or whether it is really a modification of the existing contract. This will be considered a new contract if the promised goods or services are distinct, that is, that the company is selling them separately and they are not interdependent with other goods and services, and that the company has the right to receive an amount of consideration that reflects the standalone selling price of the promised goods or services. If both of these criteria are not met, then it is considered a prospective modification. It's going to be accounted for in the period of change and in any future periods, but no changes to previously reported results. There is an example on the next page here, but I'm not going to walk through it. You can read it on your own. Okay, now we're going to move on to presentation and disclosure. So when it comes to presentation and disclosure, there are a couple of things to consider. The first is cost to fulfill a contract. So sometimes it is not free for a company to fulfill a contract. And so companies need to divide fulfillment costs, also known as contract acquisition costs, into two categories. Those which give rise to an asset and those that are expensed as incurred. So we are going to recognize an asset for any incremental costs that are incurred to obtain a contract with a customer. Incremental costs are costs that wouldn't have been incurred if the contract had not been obtained. And the key to remember here is that we can only include direct, incremental, recoverable cost where the amortization period or the amount of time that we're going to spread the cost out over is greater than 1 year. When it comes to presentation, we also need to look at collectibility. And that is that the credit risk that a customer will be unable to pay in accordance with the contract terms. So I mentioned earlier that whether or not a company will get paid is not consideration for determining revenue recognition. We just need to make sure that the customer entered into the transaction in good faith. The amount recognized for revenue is not adjusted for customer credit risk, and instead there's a separate process for assessing the allowance for bad debts / uncollectible accounts. When it comes to what is required to be disclosed for revenue recognition, companies are going to disclose qualitative and quantitative information to help financial statement users understand the nature, amount, timing, and uncertainty of revenues and cash flows. With the contracts with customers, they need to explain the disaggregation of revenue, they need to reconcile their contract balances, and they need to disclose any significant remaining performance obligations. When it comes to significant judgments that are used in the revenue recognition process, they need to discuss how they allocate the transaction price and also how they determine the timing of their revenue. When it comes to assets that are recognized from costs incurred to fulfill a contract, they need to talk about the amortization recognized and the method used for amortization, which most likely is going to be the straight line method. So that ends this part of the lecture. I mentioned that next up is long-term contracts, and I will be recording a separate video for that.